For more on the markets, let's bring in Kathryn Rooney Vera, Chief Market Strategist at StoneX. Kathryn, great to have you with us.
It's going to become a meme. I shouldn't have done
right now as we're speaking. Kathryn, great to have you. What did you make of the rally yesterday? Do you believe that this rally's got legs? I mean, the 10-year yield being below 4.5 really gives a lot of runway for stocks.
It does, unless the bond yields drop is because, of course, of a rollover in the U.S. economy. So what are we really rooting for here? The U.S. economy gaining traction and remaining strong, in which case inflation could resurge and the Fed has to hike in the future, or an economic rollover and consumption contraction, in which case the Fed would be cutting. That would not be good for equity risk premium. So at this point, I think that the markets got ahead of themselves somewhat yesterday, Melissa, and rallied significantly. The playbook being the Fed's on hold, the Fed's going to cut, buy risk, with everything you can.
Do you think that soft landing is on? Is that the foregone conclusion? That's what the markets told us yesterday. That's what consensus. If you take a look at consensus 12 months ago, I think the majority on Wall Street thought there was going to be a recession in the next 12 months, and now it's virtually zero.
Right. I think the markets are pricing in soft landing, which is historically an improbable event, historically unlikely. Next year's S&P earnings growth of 12%, I think, is probably optimistic, especially given a triple whammy of margin pressure. I think that's going to come upon corporations next year. How can they continue to expand margins when you have high energy inputs, high labor costs still out there, and high real interest rates, and nominal growth rates are probably not going to be the 5.5% that are basically baked into that 12% earnings growth. So I suspect there's going to be earnings revisions to the downside, and margin pressure will likely cause this job hoarding that we've seen post-pandemic to go away, and we could see additional job shedding. So I guess my basic point, and I kind of agree with Jamie Dimon, who yesterday talked about risk management. I think it's time to engage in counter-cyclical portfolio policy, which is at least protecting yourselves for the possibility of a stagflationary scenario or a recessionary scenario.
So what sectors would that mean? I mean, healthcare overall. I mean, you've had, a couple of winners within the healthcare sector, and the rest of the health, if you take a look at Novo and Lilly, for instance, they're the big winners at the expense of a Merck, a Pfizer, you name it. So how do you think of that counter-cyclical, playbook?
Yeah, well, fixed income, I think, is going to continue to do well versus equities next year. And then within the equity space, Melissa, utilities, of course, is a bond proxy. I suspect that's going to be one of the better performers next year. Staples, healthcare, you mentioned, insurance, I think are the plays for next year. And I would suggest at least buying puts or hedging with options on the technology portion of a portfolio for next year, especially given the headwinds that I think are currently, as you mentioned, really not priced in at the moment.